So now that we've discussed all the major laws of market behavior, we're going to drill down a bit and discuss a concept that will make things easier and simpler to understand as a whole. And this concept is that of key reference areas. Everything that we've discussed up till now may seem complex and hard to put together, but using key reference areas will allow us to take all that market complexity, all that movement, all those different patterns and the fractal nature and everything happening all at the same time, and narrow it down so we're able to zero in on the important places. And these important places will give us a lot of market information in and of themselves, and will allow us to relate price movement to them to make some quick conclusions about what's happening in the market and what's likely to happen going forward. So let's get right into these key reference areas. There are four major ones that we use in our trading and that make market action easier to decipher. And that first key reference area is what's called buying and selling tails. So let's get into it in the price chart. So take a look at this chart. What do you see in it? Can you make any general observations? Are there any important market behavior you see happening? Well, if you know the basics of markets, like we've been talking, you'll be able to say, for instance, this was an uptrend right here, the market hit a stopping point and then started balancing sideways, right? Okay, that's good and that's general, but how can we drill deeper into this? What areas in this chart are of importance when you go deeper in? And what can they tell you about what's happening in the market and what's likely to happen going forward? That's really what we're trying to look at here. So the first key reference area that we're discussing is buying and selling tails. Now what is a tail? Well, think of what the normal word tail means and take a look at this chart and tell me if you can see a tail in this chart. Go ahead and pause the video for a few moments and just look at the chart and check it out and see if you can point out where there's a major tail in this video. Okay, well, let's see if you were able to pinpoint it. Now, in reality, if we drill down into this chart, you'll find several tails, quite a few. But the main prominent one that you can see right away is this right here. This is a selling tail. And why is it called a selling tail? What is it and how is it formed? A selling tail occurs when prices have been moving up, right? Buyers are moving the prices higher, aggressively buying, and price hits a level, right, where a wall of sellers exist. So literally think of it like a wall. Price hits a point where there's enough sellers there that absorb all that buying demand, right? So let's say we're looking here at price 1330. Buyers are aggressively buying it higher and higher and higher. They come to 1330. Let's say there's 500 buyers all looking to buy 5 contracts each. So they want to buy 2,500 contracts. Okay? Well, at 1330, there exists more than 2,500 contracts for sale. Okay? Let's say there exists 4,000. So these 2,500 contracts that want to be bought at this price are all bought, absorbed, right? And there's still 1,500 contracts left for sale there. So price cannot move higher. Now these sellers that are sitting there selling at 1330 feel that the market is overvalued. They feel that value should be lower and that this is a good place to sell. And in this instance, they're pretty aggressive in their views. They feel that the market has just gone up too high and maybe there's some new information to tell them the market should be much lower. Alright? So not only do they have these 4,000 contracts they were selling at 1330, but now they aggressively start selling even lower, right? They drop down to 1329 and they want to sell some contracts there, and there's not enough buyers to buy all of it there, so they drop down even further. And they're doing this fast and aggressively. Well, what ends up happening when they do this is that here price had gone up and then all of a sudden it just snaps back in quickly without making any sideways movement there, without spending time there. Alright? And when this market does this, when price just snaps right back in, hits this area, and they just sell aggressively, you get a tail. The price had gone up and gets snapped right back in without spending time there. And that's what a tail is. And what it's showing is price rejection. It's showing aggressiveness of the other side. In this case, it's the sellers. And so accordingly, this is a bearish sign. When you see a selling tail, the only way it could have happened is if price had been moving higher, hit an extreme in buying, and then the sellers turned it right around and just crushed all the buyers. And now usually these buyers are stuck in their positions, they end up selling, and it accelerates the other way. So a selling tail tells you that the market had gone too far away from its true value, sellers had gotten aggressive, and now are returning it to its true value. Now what's a buying tail? Well, it's the exact opposite. Let's take a look at a different section of the market. Okay, we're in a same market. This is still the S&P 500 futures. We're looking at a 5-minute chart. Again, these principles will apply not only to any other market, but also to any time frame. Whether you're on a 5-minute chart, a daily chart, a 1-minute chart, doesn't matter. These are all the same principles. So a buying tail happens in the exact reverse order. Market's selling off, right? Prices are going down. Sellers are aggressive, but they hit a point where there's just a wall of buyers. That's how you have to think of it in your mind. Use these type of analogies, like literally hitting a wall, where they're selling, but there's more than enough demand just sitting there to absorb all the selling. And not only that, buyers at this point, for whatever reason, there could be new outside information, there could be rumors, there could be real news that change the whole fundamental supply-demand equation. Doesn't matter. The prices and the chart tell you what's happening without you needing to know what the news was or what the rumors were. That doesn't matter. It's all reflected in price. Remember the law that the price discounts everything efficiently? Well, this is happening right here. And so these sellers are aggressive. They were selling it. They hit this wall of buyers, right? And buyers snap it right back up. The buyers become aggressive. It's a complete reverse in market behavior. And the buyers get aggressive and they start buying it up, and this becomes a buying tail. And momentarily, this becomes a key reference area. And here's the powerful thing about key reference areas. Not only do they tell you what's actually happening in the market and explain the overall view of who's in control, was it the buyers or the sellers, and what's likely to happen going forward. For instance, when you see this strong tail, the likelihood is that prices are going to keep going up for at least a reasonable period. What will end up happening too is that these key reference areas will then serve as either support or resistance when price approaches them the next time around. And this, going back to Law 10, where we talked about previous market behavior, affects current behavior. This is this in action. And so you see, after price came down towards this key reference area, towards this buying tail, it hit it and instantly bounced higher. And even the next time around it came around this area, again, don't look at things to the exact tick. You're not going to come, sometimes you will come and test it to the exact low, but it's a general area. It's a key reference area. We're not saying key reference point area. So just look at it as a whole area. This looks like a tail right here. And that tail doesn't have to be exactly 1 bar. Look here, it's like 2 or 3 bars. That's not what really matters. It matters, does it feel like a sharp move? Right? You just glance at it. It's just a visual thing. Does it look like a sharp move that spent very little time there? Yes, it does. That's it. So even again, when we came back here, we tested it, and then finally we broke through it. And you'll also notice something else that reference areas tell you, and that's that not only will they act as, for instance, support in the case of a buying tail, but once they're finally broken, the market will accelerate the other way oftentimes. So they give you so much information. Instead of just looking at a bunch of squiggly lines and wondering what this means and all, it looks chaotic if you're just looking at it in general. Once you have these key reference areas to focus on, it gives you a much better understanding of the market. And that's why we call them reference areas. They become like a line in the sand. At those points, something happened. Something was significant happening in the market. And not only do they tell you something about the underlying behavior of the market participants, of the buyers and the sellers, but they also end up influencing future prices, and they tell us something once they're taken out the other way. They tell us that whatever condition was existing here, the fact that this area was seen as too low, and that's why these guys snapped it up here and again and again. Now, once it's broken, this view has changed. This area is no longer seen as too low, and the sellers have taken control, and we're below this line in the sand. And now we can reasonably expect that prices can accelerate the other way. Of course, this all will depend on much larger contextual patterns and an understanding of exactly what's happening in the bigger picture view. But first, you have to understand these specific key reference areas to then understand context after that to be able to put a whole trading strategy and plan together and really know how to trade the markets. But these are a great starting point. And going back to the selling tail from before, right? This ends up acting as a resistance area the next time price will approach it, as you see happened here. And let's move in a little closer on that. This whole area right here was the key reference area, not just like the top of it, but the general whole area. The next time price approached and it was moving really hard up towards this area, look at this. Look at this tail it left. This shadow, this wick without a body, meant that this candle was moving all the way up here and just got snapped back instantly. And then it went up again and it got snapped back all the way down to here. Right? So a really strong up move hit this previous area and just got killed right back down. And the reason for that is, one, again, it's that self-fulfilling prophecy, law number 10, and all that kind of thing that we talked about. Everyone's watching this area. Two, those who had sold aggressively in this area at this point, if they still have the same opinion about where value should be, will sell again now. And any buyers that are still caught with long positions at this point will now sell to get out at break even here. So this causes the big drop down. So always be thinking about what are other participants doing. Alright, so now let's get to key reference area number 2, which is range extremes. Now this key reference area is very similar to what we were talking about with tails, but it's a more specific example of it. And it happens with specific regard to references in time and also a compounding of several tails. And so let's actually take a look at it on the price charts and see what it means. So range extremes are the edges of identifiable areas. Now the extreme can be time-based or it can be based on market structure. And let me explain what that means with a market example. Let's move closer here to this day. Okay, so on your screen you see about 3 market days. 1, 2, 3. There's one here that's, only half of it showing. So this is the day we're talking about right now. Okay. Now up until this point right here, from the market open, which was this point here, until here, which was less than 2 hours or so, this was currently the high of the day. And it also happened to be a small selling tail. If you see, price got up here and then quickly got rejected and left this little bit of a shadow. If we go closer, you'll see it better here. Okay. Now, this, since it's the current high of the day up to this point, now when we move away from it, becomes a range extreme. Okay. The range in this case is the current day, and it's the high of the current day. And this is the low of the current day, which is a mini buying tail here. And it's the other end of this range extreme of the day. The range of the day is from here up to here. Okay. Now often what will happen is once price later in the day comes back to either one range extreme or the other, that range extreme can often act as either support or resistance. In this case, since we're moving back towards the high of the day, it acted as resistance. Now this isn't automatic. It's not like every time it's gonna do this. It's contextual, right? It depends on the context. But first we have to study the specific cases themselves. First we have to study the principles and foundations. Then later we can start understanding context and how to put it all together. But you can't understand context before you understand the pieces of the puzzle. Alright? And these are just pieces of the puzzle, these key reference areas. And so as price moves back towards this previous high, this high acts as resistance. Buyers try to go through it, get rejected, form a selling tail, right? Which is information in and of itself. that's telling us this area above here is not being accepted. Price is not spending time up there. It gets rejected. They try again one more time here, and then once they fail, they get taken down all the way back to the bottom and form a new low. Alright, now even here, if you notice very subtly, at this range extreme, if we go a little closer, right, you'll notice that it was coming down. When price hit this previous low, there was a small bounce right here. Now it wasn't big in this instance because the selling pressure was great, but despite the selling pressure being strong, it still bounced a bit. Now this is what will happen the majority of the time. Obviously, if this was going to be a real strong trending move and the big money players like we talked about before were driving it down with conviction on high vertical volume, right, all in one directional conviction, then sometimes the current high or low of the day is not going to make much of a difference. They'll just bust right through it. But on most days, the market is not trending with directional conviction one day or the other. And because of this, these range extremes do often act as support and resistance. So that's in the case of a current day. So that's the first important range extreme, is what is the extreme established so far in the current day if you're day trading. Now the second extreme is what was the high or low point of the day before. Alright, and in this case, let's take a look at this example. This was the high the day before. The market gapped down on this present day, which means that it opened far lower than the closing price of the previous day. Okay, so this was the high. The market closed at the high that previous day. Well, notice now if we look at the context of this one, which we were talking about as it relates to this, right? Well, this range extreme itself happened because of the previous day's extreme. So again, often this is like a self-fulfilling prophecy that plays out. Everyone's looking at the charts, everyone sees the high of the day before, right? And not only was this a high the day before, but the market had gapped down from it. So it also ended up being a place where sellers came in aggressively and gapped the market down the next day. So when we go back here, a lot of people are thinking there's going to be sellers still active there because they were active there the day before and caused this drop, right? So a lot will sell just based on that reason. Some others, maybe there are still sellers there. So this is why it ends up acting as resistance and causing this to happen. And if we look at it even the next day, okay, these were the highs of this particular day, right? These 1, 2, 3, these areas. Well, look what happened the next day. We come up here, we touch it. We come up here, we can't break through it until we finally get through it here on big volume. And that's the only way we were able to get through these, is through the big volumes, through the directional movement. Now things don't always play out this exact, It just depends on the context, but often it just pays to pay attention to these areas. Sometimes they just cause a little bit of a down move, for instance here, a small reaction that's not even worth trading. And other times they cause a big reversal, like here. So always be on the lookout for the current day's extremes, right? The range extremes, and the past several days, right? The past 2 or 3 or 4 days if you're a day trader. And it could be more depending on context. If you're swing trading, if you're not day trading, understanding these intraday extremes helps with getting in at the right prices for the bigger trades. And for you, the relevant range extremes may be 2 weeks back, right? So now I've zoomed out the chart and looking at a bigger perspective. Here we're in a major balance. This was the area we were talking about before. These were the 3 highs. And then the next couple of days that all were getting rejected, the same area. We finally broke out of this major balance. We trended higher. We balanced up here. We've reversed and we came all the way back down. So if you were trading this particular day, whether you were day trading it or swing trading it, okay, and you weren't focused on the previous market history, you weren't focused on the key reference areas of previous market structure, all right, you may not have known this would be an important price. But looking back here, you saw 1, 2, 3 areas, 3 key reference areas before, and sure enough it bounced here, came, tried to test it again, bounced, and then ended up flying higher, right? and then even tested it one more time close to it and then flew way higher. So the point is that all this market structure is important, and these key reference areas, you just look back in time and where are the noticeable highs and lows. That's what matter. And if you recognize, if you zoom out, these are in themselves tails. This was a buying tail, so was this, so was this, right? But here we're looking at them as range extremes. It's not just any buying tail or selling tail. It's when they made the major extremes that they count as the range extremes key reference area.